Hello, Accounting 1 students. It's Mrs. Bloomquist, and we are now moving into Chapter 11. Chapter 11 deals with accounting for transactions using a general journal, and Lesson 1 in Chapter 11 deals for accounting for purchases transactions using a general journal. So the three objectives of this lesson: explaining the purpose of the general journal, to account for purchases, returns, and allowances, and then also to post general journal to the accounts payable ledger and then to the general ledger. So one of the things you just want to be aware of is that a general journal is just a journal that has two amount columns where you can post all kinds of entries as a debit and a credit. Recognizing that not every transaction when you're dealing with the business can be recorded in some kind of special journal. So, you might be looking at something, it's not a cash payment, so it can't go in the cash payments journal. It's not a purchase, so it doesn't purchase on account, so it doesn't go in the purchases journal. And so things that can't be recorded in those two places go into the general journal. One thing that you want to be aware of is that when we purchase supplies on account, we often note these using a memorandum or a memo. So memo for buying supplies on account, you can see that this memo right here, there's an invoice that is for supplies that were purchased on account, but they don't go in the cash payments journal and they don't go in the purchases journal. So this would go into the general journal. So for buying supplies on account, here's an example. On December 2nd, we bought store supplies from Etsy Supply for $165.24. Now, when we look at our supplies account, we're going to notice that a debit is going to increase the supplies, and the credit is going to also increase accounts payable. So when we note this on our general journal, we can see that it's memo 42 in the document number, and we are debiting supplies and we're crediting accounts payable or Etsy Supply Company. So there's the date, the title of the accounts, the memo, the debit, the vendor title, and the account title and the vendor name, and the credit amount. We put a diagonal line in the post reference because we're dealing still with that memo 42. So the debit memo for purchases, returns, and allowances. Sometimes companies receive materials that are not good quality, or they're different from what we ordered, or they're damaged. And you don't want to pay full price for things that are either not good quality, or they're not what you were supposed to get, or they were damaged in shipment. And so you want to have an account where you can record purchases, returns, and allowances, because as a business you would want to keep track of, hey, if you have one vendor where things keep coming to you damaged all the time, you might want to consider switching vendors. So there are some good business reasons why you would want to track this instead of just doing the credit back to your supplies account. So what we're looking at here is that sometimes we allow a credit sometimes a credit is allowed for the purchase price on returned merchandise, and that results in a decrease on the account payable to the vendor. So that's the purchases return. If the merchandise is not returned, but it's some kind of maybe bad quality or damage in shipment, that would be a purchase allowance. And then the form that we would use to document this, because remember we always need to have paperwork so that we have some kind of audit trail, that would be called the debit memorandum. So here it is, we're looking at it as a debit memorandum, and you can see that we're receiving a debit of $43.90 based on some power tool batteries. All right, so journalizing purchases, returns, and allowances. So you can see we returned merchandise to Mobley Tools for $43.90, and that covered purchase invoice 528 and its debit memorandum 38. So on a previous invoice, we returned some merchandise to Mobley Tools. Our accounts payable, the debit is going to reduce the amount of our accounts payable, and we're going to increase the amount that we have in our purchases, returns, and allowances. So you can see that on our general journal here, we're recording we did it on December 8th. The account title is Accounts Payable from Mobley Tools, and it's a debit memorandum 38. The purchases returns allowance gets a credit of $43.90. All right, so then when we post from the general journal to the accounts payable ledger, now we're going to go ahead and say the supply from Etsy Supply, we're just transferring that credit information, $165.25, and it increases the amount of money that we owe Etsy Supply. And if we are looking at then Mobley Tools, we would be doing the same thing in Mobley Tools. So Mobley Tools, we have an additional debit of $43.90, and that increases the whoops, sorry, somebody poked their head into my room and I had to look at them quick for a second to let them know. So when we're looking at Mobley Tools, remember, we were returning merchandise to them. So that's why this is a debit, and it's actually reducing the amount of money that we owe that Mobley Tools. So when we're going ahead and posting from the general journal to the general ledger, you can see now our supplies on our page 12 are a debit because we increased the amount of our supplies, and our accounts payable also increased, and it increased by the amount that we owe Etsy Supply Company. All right, so as we go ahead and audit our understanding, when is a transaction recorded in a general journal? And we always use a general journal if we can't use those special journals. When is the equality of debits and credits proved for a general journal? And this is an important concept. When do we make sure that our debits equal our credits? We do that every time we write something down in the general journal. So each time we put something in the general journal, we need both a debit and a credit. Primary difference between a purchases return and a purchases allowance. Okay, so remember, a purchases return is a credit allowed for the purchase price of return merchandise. So if we return stuff, that's a purchases return. A credit is what happens not because we return something, but because maybe something was damaged in shipping or because the quality was different than what we ordered. So the allowance, we keep the material and we get a discount. Purchases return then is when we actually send something back. If purchases, return, and allowances decrease the value of purchases, why are returns and allowances credited to a separate account? And this is really all about better information and tracking. Businesses can look at these allowances and returns over a fiscal period, and they can really evaluate, are they buying from the right people? Are they being efficient? Are they managing their business appropriately? So this is a good account that we definitely want to have and definitely evaluate at a month-end or a quarter-end timing. All right, so at this point, please go out and do those forms online, and then you should also go ahead and do the work together and on your own for Chapter 11-1. Thanks. Good luck, everyone.